information.
Yes, it was. So what we did was we analyzed a very large sample of bond sales in the structured finance market. That's bonds that are backed by payments on commercial and residential mortgages, auto loans, student loans, and the like. And we wanted to see if there were signs of rating inflation. So what we did was we looked at all six rating firms that are active in that market, not just.
And there's some new ones.
There's some new ones, right?
That have come in since it was dominated by Fitch, S&P, and I can't remember. Moody's.
Yeah. So after the financial crisis, three firms challenged them for market share: Kroll, DBRS, and Morningstar. And what we found was that they showed a tendency to award higher grades when rating the same bonds than the big three. And part of that reason could be because if you're a smaller rating firm, if you want to get chosen to rate a deal, issuers still get to control who hires. They're the ones who hired the firms to rate the bonds. And so if you're not giving the most favorable grades, there's less likely.
So the money was following the higher ratings, and that is how they were marketing themselves?
No, the way rating agencies market themselves is on analytical excellence. You know, we provide the best analytical excellence service to investors who they call their customers, providing timely research and the like. But at the end of the day, it's not the investors who pay for the ratings, it's the bond issuers, and they have an incentive to pick the rosiest ratings because the higher the rating, the lower their interest costs, the more money the investment bank can make selling the debt.
Were there a certain type of bonds that you found the most issue with?
Yeah, commercial mortgage-backed securities, CNBC is the one where we've heard a lot about rating inflation. And when we looked in that market, we saw those patterns were quite pronounced. And we found some deals where, you know, it was pretty clear that the ratings that were assigned to them, you know, just weren't merited.
Is the problem as acute as it was pre-financial crisis? A lot of people, as we said in the introduction, thought that this was a problem that had been hosed out of the system, but clearly it hasn't been.
No, because it's the same business model. It's the main thing that Congress didn't change after the financial crisis is they said, hey, issuers, you can still pay for the ratings, and so that gives them leverage to decide who to pick, and of course they have an incentive to pick the best ratings. So because that wasn't fixed, that whole dynamic is still there. Now we're not seeing mass downgrades yet like we were in 2007, so maybe it's not as bad yet as it was back then, but there's certainly investors who worry that this shopping dynamic where issuers shop around for the best ratings, that if it's left unchecked, it could potentially lead to that again in the future.
So what's the lesson for investors? Don't pay so much attention to those bond ratings?
Well, they'd like to, but not everyone has time to do their own research, right? It's like, do you have time if you have a deal that has like dozens of loans in it? Do you have time to look at every loan? Or if you have a consolidated, if there's an analyst at a rating firm who's done that research for you, that you can look at that and rely on it.
Do big investors still rely on the ratings to the same degree as they did, or are they more skeptical today?
So there's definitely more skepticism. That was one main thing we found, was that we heard a lot of investors expressing skepticism about credit ratings, but we also found that not everyone has the time to do that deep dive research on the loan. So, for example, in the mutual bond fund industry, which is $4.4 trillion, most funds have investment mandates that make either direct or indirect references to credit ratings, which say you got to have a rating from either one of the big three, Moody's, S&P, or Fitch, or you got to have an investment grade rating. And that means credit ratings, more than a decade after the crisis, are just as much entrenched into the fabric of Wall Street as they were back then, if not more.